Hey everyone, welcome to another episode of AdMail. This is Adam Bergman, founder and CEO of IRA Financial. I'm here to help you find the answers to the most frequently asked questions from my clients about self-directed retirement accounts. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Hi everybody and welcome to another episode of AdMail. I'm Adam Bergman, tax attorney and founder of IRA Financial, and on today's podcast, Prohibited Transaction episode number 2. This is going to be a probably 7 to 10 part series. I haven't figured it out yet because I want to determine how many questions and how many episodes I'm going to need to kind of tackle a good chunk of the questions in the queue that are related to prohibited transactions, which is definitely the most popular category of questions involving self-directed retirement accounts. So if you have questions and you want me to answer them, simply send an email to info@IRA Financial. Just say AdMail or Ask Adam and type in your question, and you don't have to even be a client of IRA Financial. Happy to answer it, and it's totally confidential. You can also submit a question on our social media feeds like YouTube, Instagram, X, Facebook, LinkedIn, whatever. You can find us. You know where we are. But this podcast is going to focus on 3 questions involving prohibited transaction related questions. So without further ado, let's get questions. Let's get started. First question is from Gary V. Gary wants to know, I just want to confirm that I can transact with my stepson, who I have not adopted. So before I get into the details on your question, Gary, let me briefly just provide an overview of the prohibited transaction rule. So the IRS doesn't say what you can invest in, only what you cannot invest in with a retirement account. With respect to an IRA, there's only 3 things you cannot do with an IRA. Can't buy life insurance, can't buy collectibles, and those are both under Section 408 of the tax code. Then third, the broadest category of prohibited transactions are found under 4975 of the tax code, and 4975 says, in a nutshell, the following. You cannot do anything with your IRA that in any way, directly or indirectly, personally benefits you as the IRA owner, your lineal descendants, your parents, your children, your spouse, daughter-in-law, son-in-law, or any entities controlled 50% or more by such persons. In other words, when the IRA makes an investment, it must be done to exclusively 100% benefit the IRA owner. There cannot be any personal benefit to you or a disqualified person. So Gary, going back to your question, a stepchild is technically not a lineal descendant. Now, if you would have adopted this individual, your stepson, and the stepson became your son, then yes, that individual would become a disqualified person in that scenario. But right now, as a stepson, technically, you can transact with that person. You just want to make sure, Gary, that none of that will come back to benefit you or your spouse. Okay, so just be careful. So if you just gave him the money and he used it to build out a new bathroom in the house you live in, probably not a great fact. But if you lent him the money because he's starting a business and he's going to own 100% of the business and you're not going to personally benefit, I think you're good to go. So thank you for that question, Gary. Second question is from Mike A. Mike wants to know, I have a longtime girlfriend and we live together. Could I do a loan to her with my self-directed IRA? Would that be disqualified? So similar to Gary's question, girlfriends are not spouses. So technically you are able to transact with your girlfriend. Now, if you live together in your common law state like California, it's kind of grayish. Are you considered married? For certain purposes, yes. I still think even if you live with the person, you're not married. The federal government doesn't follow, state law. So I think you're going to be okay there. The issue, again, like Gary, is if you give your girlfriend a loan and she turns around and buys you a present with it, or fixes up your bedroom where you guys reside, or fixes the pool in your backyard that you use, I think that's a conflict of interest. I think that's a problem. It's probably prohibited, Mike. But your girlfriend needs the money because, again, she's starting a business or she's got some type of medical bills or some past liability that doesn't personally involve you. I think you're okay. And I don't think your girlfriend would be deemed a prohibited, disqualified person under 4975. But again, just make sure, just like Gary, that nothing comes back to in any way personally benefit you or your lineal descendants, because then the IRS could argue there's what's called a step transaction doctrine, meaning the loan to your girlfriend is basically a sham, and all you're doing is trying to help yourself because that money is going to circularly get back to you. And the IRS would stop that and look at each transaction and group it together and not treat it as separate transactions, but to basically collapse it. So you just got to be careful, both Gary and Mike, on that question. Third and final question is from Rachel S. And Rachel wants to know, my office manager is like a son of me. He needs some help paying off credit card debt. Can I use my self-directed IRA to lend him the money? I plan on leaving my business to him, but right now he owns no equity. So Rachel, again, thank you, Barry, by the way, produces the show, for putting these questions together. They're very much linked and related and connected. And I think that's very helpful for me. Once you kind of understand the prohibited transaction rules, you now, based off what I've talked about in the beginning of this podcast about what the prohibited transactions are, the three categories of prohibited transactions: life insurance, collectibles like art, and thirdly, transactions involving disqualified persons under 4975. I think seeing scenarios, questions, examples that are similar kind of help you get comfortable with the rules. So Rachel, again, your office manager, assuming he's not related to you, I assume he's not a lineal descendant. You said he's like a son to you, but assuming he's not your son, he's not your father or grandfather, or anyone related to you, brother, son-in-law, daughter-in-law, well, clearly not a daughter-in-law, but like a son-in-law, I think he's good, right? The fact he owns no equity, even better. But even if the office manager owned equity, if you own less than 50%, that's a good fact. But if you own more than 50%, so this is an area of the 4975 E2 disqualified person rules not a lot of people get. So this is how it works. A person could technically be disqualified if you own 50% of a company or more, and the person you want to transact with, this office manager, owns more than 10%, or is a highly compensated employee, makes more than 150K or so. He's an executive director like this person. That person becomes disqualified, even if they own less than 50%. But in order to trigger that, you have to own more than 50%, and this individual needs to own at least 10% or be a highly comp person. So in this case, if you own more than 50% of the business, Rachel, which you do, if the office manager, even if they own no equity, if they are a director, officer, highly competent employee, you could be in a situation where this office manager is a disqualified person. So you just have to be very careful. I don't have all those facts, but if you go through IRC 4975 E2 and you look at it, a lot of people don't go through and look at the actual definition of disqualified person. They just kind of stop at the 50%, the lineal descendants, and they don't understand it could be triggered if you own more than 50% and the other person's an officer director, someone that has power responsibilities similar to an officer director, or a 10% or more owner. So in this case, this office manager could be a disqualified person, even though he's not related to you. But because I assume you own more than 50% of the company, Rachel, then if he is office manager, he probably has similar responsibilities as an officer director. I think it's possible, or he may be highly compensated. He is probably a disqualified person, and you're not able to transact with him, even though technically he owns no equity and he's not related to you. So you got to be very cautious. But because you own more than 50%, I assume, and he is an officer director, he then becomes disqualified, even if he owns less than 10%. Okay, so be cautious. But remember, that only gets triggered if one person owns more than 50%. Rachel, if you own 42%, and this you want to do a loan to this person, you'd be okay, because you wouldn't have triggered the 10% officer director provision because there's no 50% or more threshold. So you have to be 50% or more and then have an officer director or 10% shareholder. But if you don't have that 50% or more, because you're not going to be described in a section that's going to trigger this provision, and it's not a lineal descendant, then the provision doesn't get triggered, and then you can transact with the person, even if they are an officer or director or highly compensated, but because you don't own more than 50%, that provision under 4975 E2H won't be triggered. So great question. Not sure if you understood the rules, Rachel, or you want clarity on that, but really good questions, Barry. Again, thanks for putting this together. That was a great one, because if you look at it on its face, you're like, oh, of course you're going to be able to do it. He's not your son. You're not related to him. He owns no equity. For sure, you can transact with that person, 100%. But under 4972 E2H, if you own more than 50%, Rachel, and he's a highly competent officer and director, which he probably is as an office manager, you trigger the disqualified person rules, and this office manager is disqualified, even though technically he owns no equity. So great question. Thank you, Rachel. Thank you, Mike. Thank you, Gary. And thank you, everyone, for listening. If you're watching on YouTube, also really want to thank you. Hope you guys enjoyed today's podcast. It's a weekly podcast. It drops every Friday. I've close to episode 200 on this. So I've been doing this for a bunch of years, almost 4 years, a little over 4 years. So I love it. It's so much fun. It's great to learn from each other, get interesting questions that I sometimes really have to put in my thinking cap, and on occasions even have to reach out to colleagues, tax attorneys, or risk attorneys to kind of get their thoughts on them as well. So thank you so much for participating. If you do have questions, please do not hesitate. Don't be shy. First thing you learn in law school, there's no dumb question. So if you have it, there's probably thousands of people that have the same question. It's confidential. I'm not going to tell people where you live or your phone number, your email address. Don't worry. Just your name and first letter of your last name, just so people know it's real and I'm not making them up. Otherwise, have a great day, and I'll talk to everyone again next week. Thanks.